With D&O hard market trends continuing, Reliance is at the forefront to help you mitigate risks and find the right combination of policy coverages. Companies should be mindful to manage the risks associated with their directors and officers. Unfortunately, risk management practices are often inadequate unless the board and senior management have recognized the concerns and taken specific actions to minimize the exposures, ensure properly tailored indemnification, and insurance protection exists. Reported average D&O loss in Canada was $288,000 in 2016. In 2020, the average settlement value was $44 million. These impacts are far-reaching for Canadian companies, including financial loss, loss of man-hour productivity, negative impact to the company culture and morale, and negative impact on the brand and reputation. Through our collective years of experience, we can help you put together a risk management program by starting with implementing a risk management committee, which may include board members, senior executives, and your outside partners, such as lawyers and insurance advisors. The second step is to have a written corporate governance program that is updated frequently and communicated to all key stakeholders. It is key to have procedures that serve to clarify what potential breaches of fiduciary duty can be so that they can be avoided. Now is the time to move away from boilerplate type corporate governance and take the opportunity to go above and beyond to ensure all key stakeholders are considered and there's transparency on diversity, cyber risks, and climate change. Companies with strong inclusive governance policies, including social, environmental, governance, will have a good defense against hostile shareholders, short seller attacks, employee grievances, and cyber attacks.
Historically, D&O claims were primarily geared to public sector companies, specifically in high-risk industries such as oil and gas. But that is no longer the case. Public, private, and nonprofit organizations are being challenged by employees, shareholders, competitors, customers, vendors, government regulators, and even partners. The Me Too movement, which began in late 2017, has highlighted the widespread prevalence of sexual assaults and harassment in workplaces, and in turn has contributed to higher settlement values. Most directors and officers are surprised to learn that employees are one of the most common sources of a D&O claim. In fact, for private businesses and nonprofit organizations, employees represent a major D&O exposure. By nature of nonprofits, being tax exempt allows a nonprofit a lot of flexibility toward using financial resources to give back to the community. But how the nonprofit funnels donation money can result in litigation and claims of mismanagement of funds. As noted by Nonprofit Quarterly, the benefits of purchasing a D&O policy tend to outweigh the cost to help cover the government's fiduciary and employment practices liability exposure. Sometimes a nonprofit board is composed of dedicated volunteers who have a less formal understanding of employment practices or financial accounting. In this case, D&O insurance can ensure that mistakes won't result in your organization's bankruptcy. We are seeing increased emerging global risks, increased shareholder activism, and a surge in event and employee-driven claims in the D&O space. Along with cyber attacks and social and environmental movements, it is becoming increasingly important for companies to evaluate their D&O strategies. 3 risk management strategies are: provide training on negligence and liability, protect all employees from anticipated harm, and establish a formal reporting system for directors and officers to receive information. The key to mitigating risks is to ensure that the program is customized to manage each of the 3 sides of D&O insurance effectively. Side A, or direct coverage, provides indemnification to individual D&Os for their losses and defense costs in circumstances where a corporation is prohibited or unable to do so. This coverage is meant to provide critical personal asset protection to the D&Os. Side B, or corporate reimbursement coverage, is the corporation's coverage for its indemnification of the directors and officers. Side C, or entity coverage, ensures the corporate entity for its own exposure to securities litigation.
A common misconception is that alleged misconduct by directors or officers is covered under other liability policies, such as commercial general liability, errors and omissions, or other outside professional liability policies. D&O insurance works best when it's used alongside a risk management program and the identification system. D&O insurance also provides mechanisms for corporations to be reimbursed when they indemnify their executives. We can help you find the balance to mitigate the risks.